Something has shifted in the global financial system, and most people haven't noticed yet. While headlines focus on stock market highs and central bank statements, a quieter story has been unfolding. Governments and central banks around the world have been accumulating physical silver at levels we haven't seen in decades. Not gold alone, silver. The same metal most investors treat as an afterthought. This isn't speculation, it's documented behavior. And if you understand what it signals, you'll recognize why this moment matters. Whether you already own silver or you've been watching from the sidelines, I'm not here to sell you a dream or promise you wealth overnight. I'm here to walk you through what's actually happening, why it's happening now, and what it means for people who think seriously about their financial future. Because when governments change their behavior quietly, it's worth paying attention. Let's start with what we know. Over the past 18 months, central banks in multiple countries have increased their purchases of silver alongside their well-documented gold accumulation. This isn't front-page news because silver doesn't carry the same institutional prestige as gold, but the pattern is unmistakable. Countries that haven't prioritized precious metals reserves in years are now actively buying, not through public announcements or fanfare, through steady, systematic acquisitions that show up in trade data, refinery reports, and strategic reserve disclosures. Why does this matter? Because governments don't act on trends. They act on risk assessments. When sovereign nations quietly shift their asset allocation toward hard assets, they're responding to systemic concerns that may not yet be visible to the general public. They're not buying silver because they think it's undervalued in the short term. They're buying it because they understand something about the trajectory of the global monetary system that demands tangible stores of value. And if you're holding silver right now, or if you've been considering it, this shift in institutional behavior should tell you something important. You're not alone in your concerns. You're just early. Silver occupies a unique position in the financial system. It's a monetary metal with thousands of years of history as currency. But unlike gold, it's also an industrial commodity with applications that make it indispensable to modern technology. Solar panels, electric vehicles, 5G infrastructure, medical equipment, water purification systems, all depend on silver in ways that have no viable substitute at scale. This dual nature creates a fundamental tension. As a monetary asset, silver responds to currency debasement and inflation fears. As an industrial metal, it responds to technological demand and supply constraints. Right now, both forces are converging. On the monetary side, we're living through the largest expansion of government debt and central bank balance sheets in modern history. The United States alone has added trillions in debt since 2020. Europe, Japan, and China have followed similar paths. When governments spend beyond their tax revenue year after year, they fund the gap by issuing more currency. This isn't a conspiracy, it's accounting. And when the supply of currency expands faster than the supply of goods and services, the purchasing power of that currency erodes. That's inflation, stripped of the technical jargon. It means your money buys less over time, even if the nominal number in your bank account stays the same. Silver, like gold, doesn't have a central bank that can print more of it at will. Its supply is limited by geology and the economics of mining. That's why it's been used as a store of value for millennia. But here's where silver diverges from gold. Industrial demand is accelerating at the exact moment monetary concerns are rising. The global transition to renewable energy requires massive amounts of silver. Every solar panel uses it. Every electric vehicle uses significantly more silver than a traditional car. The build-out of 5G networks, data centers, and advanced electronics all require silver in quantities that are straining existing supply. According to industry reports, global silver demand exceeded supply in 2022 and 2023. That deficit was covered by drawing down existing inventories. But inventories aren't infinite, so you have two powerful forces intersecting. Governments seeking hard assets as a hedge against currency risk, and industries competing for the same metal to meet technological mandates. This is why governments are stacking silver now. They see both the monetary pressure and the supply-demand imbalance forming at the same time. The average investor doesn't think about silver this way. To many, silver is just cheaper gold, something you buy if you can't afford gold, or something that moves erratically and doesn't belong in a serious portfolio. This misunderstanding comes from looking at price charts without understanding the fundamentals beneath them. Yes, silver is more volatile than gold. That's because its market is smaller and more susceptible to speculative swings. But volatility isn't the same as risk, especially when the underlying supply-demand dynamics are shifting in your favor. The real misunderstanding is treating silver purely as a speculative trade rather than as a strategic allocation. When you own silver, you're not betting on a price target. You're holding an asset that has intrinsic value, limited supply, and multiple sources of demand that are intensifying. You're positioning yourself for a world where currency stability is uncertain and where industrial demand for critical materials is rising. That's not gambling, that's preparation. Another misconception, believing that the price of silver today reflects its true value. Markets are not perfectly efficient, especially in commodities where large institutional players can influence short-term pricing through derivative contracts. The paper market for silver, futures contracts, and ETFs, is far larger than the physical market. This allows temporary price suppression when institutional actors have an incentive to keep precious metals prices low. But physical reality always reasserts itself eventually. When demand for actual metal exceeds available supply, the paper market becomes irrelevant. That's when prices adjust sharply to reflect the real scarcity. We may be approaching that inflection point. History doesn't repeat, but it often rhymes. Look back at periods when government debt exploded, when central banks expanded their balance sheets aggressively, and when industrial demand for critical materials surged simultaneously. The 1970s offer one example. After the United States left the gold standard in 1971, faith in fiat currency began to erode. Inflation accelerated. Oil prices spiked due to supply disruptions. Investors fled to hard assets. Silver went from around $150 per ounce in 1971 to nearly $50 by January 1980. That's not a 10% gain, that's a 30-fold increase in less than a decade. Now, I'm not predicting silver will go to $50 or $100 or $1,000. Predictions are worthless. What matters is understanding the conditions that caused that move. The 1970s had currency debasement, supply shocks, and a loss of confidence in traditional financial systems. Does that sound familiar? More recently, look at 2020 to 2021. In response to the pandemic, governments worldwide printed unprecedented amounts of money. Central banks slashed interest rates to zero and bought assets aggressively. Inflation fears rose. Silver moved from under $12 in March 2020 to nearly $30 by August 2021. That's a meaningful gain in a short time, driven by the same forces, currency expansion and uncertainty. But here's what's different now. In the 1970s and in 2020, governments weren't systematically buying silver. They focused on gold, if anything. Today, the combination of sovereign buying, industrial demand, and supply deficits creates a setup we haven't seen before. That doesn't guarantee a particular outcome, but it does suggest that the probability distribution has shifted. The range of possible outcomes now includes scenarios that were previously unlikely. And in investing, managing probabilities is everything. If you already own physical silver, you made a decision based on some combination of inflation protection, portfolio diversification, or distrust of purely paper assets. You were right to think that way. The current environment validates your concerns. Currency debasement is real. Debt levels are unsustainable without inflation or default. Industrial demand is rising. Governments are acting as though hard assets matter. But validation doesn't mean vindication is immediate. Markets can remain irrational longer than you can remain patient. Prices don't move in straight lines. There will be periods where silver consolidates, pulls back, or moves sideways while the fundamentals continue to build. Your job isn't to watch the price every day. Your job is to understand why you own it and to hold it with conviction during the periods when the market doesn't reflect the underlying reality. If you bought silver as insurance, treat it like insurance. You don't cancel your homeowner's policy because your house hasn't burned down yet. You keep it because the risk remains real. If you bought silver as a long-term store of value, think in years, not months. The transitions we're discussing, currency regime changes, industrial supply shortages, geopolitical realignments, don't happen overnight. What you should not do is panic sell during temporary corrections. Weak hands get shaken out during consolidations. Strong hands accumulate during those same periods. You should also resist the temptation to overconcentrate. Silver should be part of a diversified approach to preserving wealth, not your entire portfolio. Balance matters. Extremes, even in sound assets, introduce unnecessary risk. And finally, stay educated. The more you understand about monetary history, supply-demand dynamics, and market cycles, the less likely you are to make emotional decisions during volatility. You're holding an asset that governments now want. That's a powerful position, as long as you don't give it away cheaply during a temporary dip. If you don't own silver yet, you might be wondering if you've missed the opportunity. You haven't. Yes, silver has moved higher from its lows, but if the thesis is correct, if we're entering a period of sustained currency pressure, industrial demand growth, and sovereign accumulation, then we're still in the early stages. The question isn't whether silver is higher than it was a few years ago. The question is whether the forces driving demand are likely to intensify or fade. Based on government debt trajectories, energy transition mandates, and central bank policies, those forces are more likely to intensify. That doesn't mean you should rush in blindly. It means you should approach this deliberately. First, educate yourself. Understand what you're buying and why. Don't buy silver because someone on the internet told you to. Buy it because you've assessed the risks to your purchasing power and decided that owning a tangible, finite asset makes sense. Second, start small if you're new to this. Physical silver isn't like buying a stock. There are premiums over spot price, storage considerations, and liquidity differences. Get comfortable with the asset before committing significant capital. Third, think long term. If you buy silver expecting it to double in 6 months, you're likely to be disappointed and you'll probably sell at the wrong time. If you buy it as a multi-year hedge against currency instability, short-term price swings won't shake you out. Fourth, don't use leverage. Buying silver on margin or through highly leveraged derivative products can wipe you out during volatility, even if the long-term thesis proves correct. Own it outright. And finally, be patient. There's no urgency to buy at this exact moment. The trends we're discussing will unfold over months and years, not days. Waiting for a pullback or buying in tranches is smarter than chasing price. The worst mistake you can make is staying on the sidelines entirely out of fear or indecision, only to rush in later when prices have already moved significantly and everyone is talking about it. By then, you're no longer early, you're following the crowd. No investment is without risk, and silver is no exception. The biggest risk isn't that the fundamentals are wrong. The biggest risk is that you mismanage your position emotionally or financially. Silver is volatile. It can drop 20% in a matter of weeks, even during a long-term uptrend. If you're not prepared for that psychologically, you'll sell at the bottom and lock in losses. Silver also doesn't produce income. It doesn't pay dividends or interest. Its value comes entirely from price appreciation, and its role as a store of value. If you need cash flow from your investments, silver isn't the right tool. Liquidity is another consideration. Physical silver is less liquid than stocks or bonds. You can't sell it instantly at the click of a button. You'll need to find a buyer, and you may pay a spread between the buy and sell price. Storage and security matter too. If you own physical silver, you need a safe place to keep it. That might mean a home safe, a bank safety deposit box, or a professional storage facility. Each option has costs and trade-offs. There's also the risk of overallocation. If you put too much of your wealth into any single asset, even a sound one, you expose yourself to unnecessary concentration risk. Diversification isn't just a buzzword, it's a risk management principle. And finally, there's the risk of misinformation. The silver market attracts hype, conspiracy theories, and overly optimistic price predictions. If you make decisions based on sensational headlines or YouTube videos promising $500 silver next month, you're setting yourself up for disappointment. The way to manage these risks is simple. Own silver as part of a broader strategy, understand what you own and why, and maintain emotional discipline during volatility. Treat it as a strategic allocation, not a speculative bet. Let's be direct about the mistakes people make during moments like this. Don't chase price. If silver has a big up day and suddenly everyone is talking about it, that's often the worst time to buy. Emotional buying leads to emotional selling. Wait for consolidation. Don't overlever. Using debt to buy more silver than you can afford is a fast way to lose everything, even if you're right about the long-term direction. Markets can punish leverage mercilessly. Don't follow hype blindly. Social media and forums are full of people making bold predictions with no accountability. Some are well-intentioned but wrong. Others are trying to pump their own positions. Think independently. Don't neglect other aspects of financial health. Silver won't help you if you're drowning in high-interest debt, have no emergency fund, or lack basic insurance. Foundation first, speculation second. Don't expect linear progress. Markets move in waves. There will be corrections, sideways periods, and moments of doubt. If you can't handle that psychologically, you're not ready for this asset. Don't ignore taxes and reporting requirements. Depending on where you live, selling silver may have tax implications. Understand the rules in your jurisdiction before you buy. And don't treat silver as a get-rich-quick scheme. Wealth is built slowly through disciplined accumulation and patient holding. Anyone promising you instant riches is either lying or deluded. The people who succeed in markets like this are the ones who stay calm, think long-term, and avoid the emotional extremes that destroy most investors. Silver is the topic of this discussion, but the principles extend far beyond one metal. What we're really talking about is how to think during periods of financial uncertainty. We're living through a time when traditional assumptions about money, debt, and economic stability are being tested. Central banks have exhausted many of their conventional tools. Government debt levels are at peacetime records. Inflation is proving more persistent than policymakers expected. At the same time, technological change is accelerating. Geopolitical tensions are rising, and the global economic order that defined the post-World War II era is shifting. In this environment, the assets that perform well aren't necessarily the ones that worked in the past. Bonds, for decades considered the safe haven, have delivered negative real returns during recent inflationary periods. Cash loses purchasing power steadily when inflation exceeds interest rates. Stocks can thrive in some conditions, but face significant headwinds when central banks tighten policy or economies contract. Hard assets, commodities, real estate, precious metals, tend to perform differently. They don't move in perfect correlation with financial assets. They offer diversification precisely when it's most needed. Silver is one example of this broader category. It's not the only answer, but it's a legitimate part of the conversation. The investors who navigate this period successfully won't be the ones who bet everything on a single outcome. They'll be the ones who diversified thoughtfully, understood the risks they were taking, and maintained discipline when markets became volatile. They'll be the ones who asked the right questions. What happens if inflation stays elevated? What happens if governments can't raise interest rates without triggering a debt crisis? What happens if industrial demand for critical materials exceeds supply? These are the questions that lead to sound decisions, regardless of which specific assets you choose. One of the hardest parts of investing isn't finding the right asset. It's holding it through the periods when nothing seems to happen. Most people can't do this. They buy something, watch it sit flat for months, and conclude they made a mistake. Then they sell, often right before the move they were waiting for. This is human nature. We're wired to seek immediate feedback and quick results. But markets don't care about our psychological needs. The best investments often feel uncomfortable. They require you to act before the crowd sees what you see. They require you to hold while others doubt. They require you to stay patient during periods of silence. If you buy silver today, there may be long stretches where the price does nothing, where analysts question the thesis, where other assets seem more exciting. That's the test. The investors who succeed are the ones who trust their analysis, who understand the difference between price and value, and who can tolerate uncertainty without panic. They're also the ones who continue to learn and reassess. Confidence isn't the same as stubbornness. If the fundamentals change, you should change your position. But don't confuse short-term price noise with a fundamental change. Patience isn't passive. It's active discipline. Let's return to where we started. Governments stacking silver. Why does this matter? Because governments have access to information and analysis that individual investors don't. They employ economists, strategists, and intelligence agencies to assess risks and plan for contingencies. When they change their behavior, when they start accumulating hard assets after years of not doing so, it signals a shift in their risk assessment. They're not buying silver because they're bullish on industrial demand alone. They could meet that need through trade. They're buying it because they're concerned about the stability of the monetary system, and they want tangible reserves. This is the same reason central banks globally have been buying gold at record levels. Hard assets don't have counterparty risk. They can't be printed or devalued by policy decisions. They hold value across different monetary regimes. If you're thinking seriously about your financial future, you should be asking yourself the same questions governments are asking. What happens if the current system becomes unstable? What happens if currency debasement continues? What happens if supply chains remain strained and critical materials become scarce? You don't need inside information to answer these questions. You just need to pay attention to what's happening and think clearly about the implications. Governments are giving you a signal. Whether you act on it is up to you. No one can tell you with certainty what will happen to silver prices in the next month, year, or decade. What we can say with confidence is that the conditions exist for significant price appreciation over the long term. Governments are buying. Industrial demand is rising. Supply is constrained. Currency expansion continues. Debt levels remain unsustainable. These are facts, not predictions. How and when the market reflects these facts in price is uncertain. Markets can remain disconnected from fundamentals longer than seems rational. But eventually, reality asserts itself. If you own silver, your job is to hold through the noise. If you're considering it, your job is to educate yourself and act thoughtfully. Either way, this moment matters. We're not in a normal economic cycle. We're in a transition period where old assumptions are breaking down and new realities are emerging. The investors who prepare for this, who think independently, who manage risk carefully, who stay patient during volatility, will be positioned well for whatever comes next. The investors who ignore it, who assume things will return to normal, who chase yesterday's winners, will likely struggle. You don't need hype to make good decisions. You need clarity. You need to understand what's happening in the world, why it matters, and how it affects your financial security. Silver is one piece of that puzzle. It's not a magic solution, and it's not right for everyone. But for those who understand the risks we're facing, currency instability, supply constraints, government debt, inflation, it's a legitimate tool for protecting purchasing power. The fact that governments are now accumulating it alongside individuals should tell you something important. This isn't fringe thinking anymore. It's prudent risk management. Stay informed. Stay disciplined. Stay patient. The financial landscape is changing. Those who see it clearly and act thoughtfully will navigate it successfully. The choice, as always, is yours.